But as we're here at the introduction of XOLARIS Group and of HHX-ESLA, I think that if we start with the introduction, then participants will not miss too much. So what I will do is I will present the XOLARIS Group from my side. My name is Ernesto Bozic. I'm here the Managing Director of Sunrise Capital, which is a division of XOLARIS Group. We're responsible for the sales and marketing for all the funds that we launch. I would like to just introduce our company to you so that you understand what we're doing and why we're conducting this webinar. And after a couple of minutes, I will then switch over to our business partners from HHX-ESLA, who are actually going to talk about the sustainable shipping topic. So as you can see, we are what we call a service AFM fund, a company that is located in Liechtenstein. We've been founded in 2010, have assets under management of around 1.5 to 1.6 billion euros. The company was founded by Stefan Kleile, who is our CEO. So it's an owner-owned company. We're independent from banks and insurance companies. As you can see, we're quite international for a small organization like ourselves, with offices in Liechtenstein, Munich, Constance, Paris, Singapore, and Hong Kong. Our asset classes, so as a fund administration service company, we are focused on real assets. We don't provide fund administration for liquid assets. We can do that, but our focus is on real assets. As you can see, we have private equity, real estate, shipping logistics, timber and agriculture. So we are purely focused on alternative investments for our clients. We do that for third parties. We don't have an in-house management. All the investment decisions, all the investment ideas are usually conducted by an external partner. In this case, it's HHX-ESLA, who is specialized in the shipping sector, and they will provide to us the investment ideas for the structure. We provide several modular services, which of course you need to launch a fund. It's the compliance functions, documentation, administration. So we provide all the services that our fund initiators, fund promoters, asset managers need in order to establish a fully regulated fund. We do that currently in Liechtenstein and then also in Germany for what we call in Germany the Geschlossene Investment KG, so which is a limited partnership that invests in real estate and private equity. Having said that, to give a short overview on the XOLARIS Group, I will hand over to Orestes Chinas, who will be guiding you through the presentation. So I will get out of my presentation and I'll give the screen to Orestes.
And to Steven, of course.
Yes. Post erstellen. All right. Okay. So can you manage the screen?
Not yet.
Wait, let me try it again. Ah, okay, you have it. Okay, good.
Excuse me. Excuse me, Steven, can you?
I think we're on the first page now. Yes. Okay.
Okay. Apologies. So, Steven, will you start with the presentation?
Certainly. Thanks, Orestes, and pleasure to be with everybody this morning. We certainly appreciate the opportunity to speak with everybody today and to brief our audience on direct lending opportunities in the global shipping sector with and through our private credit team, as Ernesto mentioned, HHX-ESLA Advisory, and our latest fund vehicle, Blue Nautilus Capital #1. Orestes, if we would just advance a slide or two, perfect. And one more, if you would, thanks, just to number 3. I thought that we'd start off today talking a little bit about the global shipping industry. I'm sure that many of you have seen recent headline news stories regarding the industry. So to start the discussion, let me just give you a brief overview of the sector. As you can see from slide 3, the global shipping market is really a dynamic industry, which is truly at the epicenter of global trade and intercontinental commerce. In fact, 90% of all global trade occurs via sea trade. So that is to say that nearly all raw materials and finished goods utilize and depend on the maritime industry to transport goods to and from market. So in many ways, arguably, shipping is the most critical driver of globalization and certainly a key to the global supply chain. What most people don't know further is that given the average size and scale of most commercial operating vessels, it's actually a much more sustainable and environmentally friendly transportation option when compared to the carbon footprint of rail, truck, or air freight. I think notably, it's also truly a global business with assets operating around the world in a multi-jurisdictional environment. It's based on established international law, long-standing operating and safety protocols, as well as we'll talk about today, significant global regulation and very stringent environmental standards that the industry has to meet. Of note, one thing I would point out, one of its uniformities is that it's also a dollar-denominated industry, therefore eliminating currency risk largely for investors. Just a word or two on slide 4 to give you some sense. There are 3 main sectors in shipping: dry bulk, containers, and tankers, as you can see on the left-hand side of the screen, and several very important subsectors therein. Typically, dry bulk vessels carry raw materials such as coal, iron ore, wheat, grain, steel, other materials, as the name would imply. Tankers typically carry a variety of wet products, crude or petroleum or chemical or other liquid cargoes. In fact, bulkers and tankers by market share represent about 2/3 of the total global fleet. So it's a large portion of the overall fleet. Container ships, or box ships as they're also referred to, generally are carrying finished goods in containers, as the name would infer. Other specialized sectors, as depicted on the slide, LPG and LNG carriers, but also specialty areas like offshore vessels, which service the oil and gas industry, ferries, cruise, and other specialized subsectors. On the right-hand slide, or on the right-hand side of the slide, you can just see a couple of key elements to a commercial vessel's life cycle, including new building, very importantly, ship finance. It's a capital-intensive industry which requires well-organized capital plan. Secondhand sale and purchase, and demolition. HHX-ESLA focuses our activities on providing alternative debt capital to the industry across several main sectors and at various stages of a vessel's life cycle. Just moving to the next page, we're talking a little bit here about the growth of seaborne trade. And I think this is an important slide as you look at the blue upward sloping line from left to right. And I would share the most important driver of the continued growth of world seaborne trade really is globalization and the interconnectivity of various regions around the world. You can see from the chart that seaborne trade has grown at an average of 3% a year for over 50 years. And so as that continues, world seaborne trade is expected to exceed 32 billion tons a year by 2030. That's not that far out. The point is that sustainable and strong fundamentals, not technical factors, really are driving this consistent growth. You can see from the pie chart that bulkers and tankers are leading the growth as the global economy expands. And I think, in short, it's a growing industry which underscores the need for additional capital to fund such growth. It's capital intensive, it's high barrier to entry. We believe that it will be alternate sources of finance that will ultimately fund the expansion of our industry in order to meet the demand needs of the future. We'll talk about this a little bit in later slides, but we certainly don't expect to see those capital needs met by banks, which does create a significant opportunity for private credit players like HHX-ESLA. Just looking again, or moving on to slide 6 to give you a better sense of the market and the cyclicality of the shipping industry. This is a pretty interesting chart from leading maritime data provider Clarkson's, and it's an aggregate index showing historical earnings, and it's broken down into the 4 preceding decades, moving from left to right on your screen. I would point your attention, interestingly, to the middle, or that period of 2000 to 2010. You can see an anomaly of higher rates and higher volatility in this period, which actually coincided with the confluence of several very unique technical factors. China's ascension into the WTO, a commodity super cycle, huge net growth of the global fleet, largely driven by these enormous kind of speculative capital investments from US private equity into shipping. You can also see it crashed at the end of the decade, coinciding with the credit crisis of 2008 and 9. It's important for a couple of reasons that we'll talk about, but namely, it was a period driven by unique technicals and really not necessarily fundamentals. The reason I spend a moment on that is because, in contrast, I just draw your attention to the current period, or all the way to the right-hand side of your chart, where we appear to be at the front end of a sustained expansion, driven by what we would argue are very strong fundamentals, not technical factors. Things like discipline and net fleet growth, much less speculative capital in the market, a lack of traditional funding, and then, against the wall of increased demand for both dry and wet capacity, the impact of regulatory reform and greening as well, and other factors that we'll talk about a little bit later in the presentation that we think set the stage for higher rates, higher returns, and potentially less volatility in our view. So just in summary, we've taken you quickly around the world in the global shipping markets. It's a key industry for the international trade and constant growth. Different shipping segments, which importantly, as we outlined earlier, they do typically independently perform, or there is a bit of an inverse relationship between it among sectors. So they tend to offer investment opportunities when one is up. Typically the other is down for a number of reasons. I think what it means for investors is there's generally always a good investment opportunity in one or more of the main shipping sectors. And certainly HHX-ESLA has the expert knowledge and experience to select the right project. We talked about this as a high barrier to entry, complex global market, and you've got to have practical experience in that in order to navigate both opportunities and risks. Just moving on to the finance markets, and I'm just going to pull one or two slides for you, one or two comments for you here on this. As we talk about the global picture, pardon me. So how do we get here? Is the question. And I think while a picture says 1,000 words, it probably makes sense to spend a few minutes talking a little bit about the global finance markets in maritime, and that landscape having changed quite a bit over the last decade. Looking at the chart on page 9, there's been significant structural change in shipping finance, and it's really resulted in huge capital dislocation in the market. That is underpinned specifically by significant or consequential regulatory and other reform, which came largely as a reaction to that fallout of the 2008 credit crisis, as you saw that precipitous drop at the end of the market in the Clarkson slide. Namely, Basel III and IV really changed the regulatory capital and loss loan provisions required for banks. And so what it means is that it made asset-backed or asset-based financing in industries like shipping much less attractive for banks, and in many cases prohibitively expensive. So the changes to the global banking rules in the last several years led to strategic decisions by many to exit the space entirely. The net result, and you can really see this from the decline in volume in the chart, is a $100 billion a year funding gap that the shipping industry has been digesting and adjusting to over the last 10 years. We continue to see that funding gap today. And it's, one which HHX-ESLA believes is a structural change that's going to invest, for a multi-year period, if not longer. Further to the point, with the retreat of global banks from the sector, we can see that within the EU specifically, German and Nordic banks not only have been the most significant capital providers to the industry, but really have been most prolific in their exit from the sector, leaving the industry, largely in a state of total dislocation. When you have that much capital sucked out of the market, there's a period of as I said, dislocation and readjustment that the industry's has had to adjust. Point is, you can see how those Basel III and 4 regulations really influenced the retreat of banks, and as they adjusted, that money essentially went elsewhere. Banks made strategic decisions to deploy capital in other areas of the market and change their business models. So shipping really has had to adjust. So I think, although the changes have been difficult for the shipping industry and a hard catalyst for banks, it's also created opportunities for private credit to enter this market. And in the absence of banks, alternative lenders charge higher yields to compensate for risk and the highly dynamic nature of the industry itself. So in every crisis, there is, an opportunity, and one which obviously we've sought to take advantage of for our investors. Orestes, if we just skip to the next, to 11, I think further to the point, I just want to illustrate the funding gap on 11, if we can move forward one slide. Thank you. So further to the point, if you take a look at this slide, the purple line at the top illustrates the continued growth of the global fleet, and the red line at the bottom illustrates the continued decline of traditional bank financing in the sector. So the delta, or the gap between the two lines, really represents, as I mentioned, both the challenge and the opportunity. The funding gap and the departure of banks has given rise to the emergence and growth of alternative lenders in shipping. We've been certainly reading about the growth of private credit globally in many sectors. Shipping is perhaps a late adopter, but we certainly see rapid growth in the space. We at HHX-ESLA were among the first, if not the first, to recognize the opportunity about a decade ago and really lead the way in establishing the high yield debt market in global maritime. And today, having brought it mainstream with other providers in the space, it's a very fast growing segment of the financial landscape in global maritime. So as we see it today, with the improvement of global macro fundamentals, the rebound from COVID, relative health in the maritime sector itself, and the sector is not a distressed one by any means, but it certainly remains dislocated given its need for capital. Importantly, we believe that the historical risk in shipping debt has also not really been priced adequately or enforced by banks, and so we do see a robust opportunity for alternative lenders to generate superior risk-adjusted returns, low to mid-teens at the top of the capital structure. Just talking a little bit about spreads, I think this chart's pretty compelling because it illustrates further the points that we've made. And two things I'd point out. The chart at the left depicts the declines in year-over-year new building financing. And the right-hand side does essentially the same thing, but really refers to syndicated or interbank lending to mostly publicly traded shipping companies. What it tells us is two important things. One, even in traditional mainstream asset finance for shipping, the cost of capital is going up. And you can see that from the red line on the chart at the right. And the duration of that financing or the tenor is going down by the blue line. So banks are not only repricing, they're also de-risking by taking shorter duration. So I think in many ways it validates the thesis of private credit providers in the space, which suggests that higher lending rates are appropriate and more commensurate with the both scarcity of capital as well as the natural risks and volatility associated with shipping as an industry. As one of the leading developers talked about earlier of the high yield debt markets and shipping, we've always felt that bank debt was probably not appropriately priced or enforced. I think you're seeing 10 years later, the industry is slowly acknowledging this and evolving its practices, even in the mainstream kind of top end of the traditional shipping market. So just concluding the comments on ship finance, obviously the market has changed and evolved and reacted to capital flight and regulatory reform. And that gap between loans and the constantly growing value of the fleet and demand is increasing. So that not only presents capital acquisition challenges for owner operators, it also presents, we think, very attractive opportunities for alternative lenders. Again, having turnkey operations in 5 countries around the world and having done this for a long time, we offer not only access to the market, but importantly, the specialty expertise to develop and manage projects on our investors' behalf. At this point, let me turn it over to my colleague Orestes. A big headline in not only shipping, but in investing globally is greening and ESG. It's certainly something that shipping from a regulatory perspective is adopting and fast evolving. And it's something you should be aware of as it pertains to not only the industry, but a potential investment in the way we approach this market. Orestes, I'll turn it over to you.
Thank you, Stephen. Thank you very much. The regulation of greening and shipping is really a very complicated issue to, let's say, present within a few slides. I would like, however, to point out some, let's say, facts, and I will, let's say, not bore you with details, but I would like to introduce you to the risks and the challenges of greening and shipping. The wider picture is a little bit, let's say, clear for the moment. Till 2030, the CO2 emissions, the carbon dioxide emissions from the operation of ships must fall by 1/3 vis-a-vis the 2008, let's say, figure. And in 2050, we have to reach the 0. These are very ambitious goals by all means. And what is very interesting is that the IMO, the International Maritime Organization, and the member states of the IMO have not decided yet how to achieve these decarbonization levels. So currently the regulatory risks are not fully clear, and that generates also some uncertainty regarding the technical and operational means that operators have to employ and deploy in order to achieve these levels. Nevertheless, this generates also a very interesting market opportunity, because it is impossible to renew the global fleet. I mean, there is a given capacity of the shipyards globally. And of course, there is also a global capacity of the capital that will be allocated to new ships. So it is impossible to renew the whole fleet. Therefore, there is a huge market opportunity that, that rests with the retrofit and investment in existing ships. So we as HHX-ESLA, as Stephen said, for relatively, let's say, many years, and being, let's say, among the first ones who have identified this opportunity, we focus on these existing ships, and we focus also on the capital needs, how to, let's say, green the tonnage, how to comply with the new regulations, how to face the new challenges. From a technical perspective, there is always this very, in my view, complicated input that people get through the media. So what are, let's say, the technical means that we have available to green the fleet? Let me be very frank with you. Some technologies are mature, some are not, but all of these technologies and all of these options, they have, let's say, some technical risks, and especially for the operators, not for the financiers. So one way is, let's say, to use alternative fuels like hydrogen, methanol, ethanol. But allow me to say that even if this alternative fuel technology becomes mandatory, these technologies for the time being are not mature. And even if they get mandatory and let's say the use of this kind of fuels becomes obligatory, then in the very first years, let's say till 2030, even till 2050, they're going to have a marginal impact on the global fleet. Can we use, let's say, other, let's say, technical means? Of course, technical improvements, better propellers, better rudders, better bulbous bows, and hydrodynamics of the ship and the new ship designs. All of it is there. But in most cases, these technology solutions correspond to new ships. Are there other technologies? Yes, like the wind assist propulsion, the wind assist technologies that result in less consumption and less emissions of existing ships. We as team, we advocate for the promotion of these technologies, and we advocate for the use of these technologies. But in any case, this is, let's say, a decision that rests with the operators. And the other, of course, interesting aspect, and this is, let's say, what the member states of the IMO try to promote as a solution, is, let's say, a set of operational means, like increasing the utilization of the ships. That is a wishful thinking, because all ship owners try to increase the utilization of their assets, but it is very difficult to make this mandatory. However, the owners will have a higher motivation, a stronger motivation to increase the utilization of the assets, because this way they can show that they use better their assets, especially when it comes to the ESG criteria. I will come to this point in few slides. But the point that I think that is very interesting is the operation of the tonnage of the ships at lower speed levels. That means that the total ton miles that the whole industry will produce will be substantially less than the total demand. And when we have, let's say, a deficit of supply, then this results in increase of the freight rate levels. And that gives room to the financiers to move. It is very important, because when we have, let's say, generous markets, let's say, when we have, let's say, markets that are strong in revenue side, then there is, let's say, room for financial engineering and financial innovation from our alternative financing side. A point that Stephen mentioned before, but I would like to provide with some textbook, concept here, is that many people think that ships are really polluting. But if you think that ships are the greener mode that we have available, and if you think that, for example, as a Panamax container ship, that in the past it used to be a very large ship, currently it's just a small to medium ship that carries 5,000 TEUs, corresponds to almost 2,116 truckloads equivalent. So assume that this Panamax does not serve, let's say, the coastal trade of Europe, then for every Panamax that does not serve this, let's say, coastal trade, then we would have 2,200 more or less truckloads on our streets. That would be really detrimental for the well-being of the coastal communities and definitely for the environment. But if you look, for example, at the case of the VLCC, a very large crude carrier that carries 2 million barrels of oil, then the truckload equivalent to 9,330 is really huge. I mean, how can we move all this energy? How can we, let's say, replace shipping? So the point that I would like to make here is that ships are fundamentally the greenest mode that we have, because the total consumption per ton mile is less than any other transport alternative. And of course, shipping is, let's say, right now focused as an industry and targeted as an industry because of the huge impact that shipping has in the global economy. But all in all, ships per se are not, let's say, polluting. Ships are, let's say, the most efficient transportation mode available. So in conclusion, regarding greening and shipping, we would like to highlight the following points. First of all, ships are the greenest alternative that we have, and we expect that more cargoes will shift from the land to the sea because of environmental policies. And we really support, as HHX-ESLA team, we support the shifting of cargoes from the land to the sea. We realize that ships must reduce emissions, and this is, let's say, obligatory. It's very clear that we have to cut emissions by 40% till 2030, by 70 or almost full by 2050. So there is a need for that. And we also realize that this will result in higher freight rates and therefore for better days, if I may use the term, for operators and financiers. And we as team, we consider ourselves not only experts, but also very confident when it comes to financing of greening solutions and generally of greening. So Steve, if you do not mind, please take the lead when it comes to the Blue Nautilus Capital One. Thank you.
Certainly. No, look, and thanks for the comments, Orestes. I think it's very insightful to understand better the actual carbon footprint and the efficiency that shipping offers. In effect, it's a de facto ESG-friendly investment on its face, certainly when compared to some other traditional infrastructure or transportation options. So I think, where do we go from here? How does one approach intelligently an investment in shipping, which not only provides above average returns at mitigation, but one which may offer ESG compliance and objective measurements? I think the opportunity in shipping and in shipping debt in particular is a message that that we've been espousing for the better part of a decade. Couple of things I would stress to here. Number one, yield. An investment in this space with and through our platform and our new fund offers potential for very attractive yield and risk-adjusted returns relative to traditional fixed income investments. And so I think you have to think about this as far as the basic challenges that institutional investors are dealing with in today's market: low rates, higher defaults, some inflation in the market, and how do you do that? How do you achieve and meet those liabilities, which generally there's a gap there for most pensions, endowments, and insurance companies through solely traditional assets. So as we mentioned, opportunity here is a couple-fold. Number one, yield. Very attractive current yield and risk-adjusted returns relative to traditional fixed income investments. Number two, security. I would stress this is a senior secured asset-backed financing. I think this can be a very attractive option for those seeking to diversify their exposure to corporate credit, real estate. In the low rate environment that we're in today, this should be a very attractive complement to that. Number three, interest rate hedge. These are floating rate securities or investments that you have exposure to. They're generally tied to a LIBOR base rate and move in the direction of interest rates. So floating rate instruments are naturally going to offset price and inflation risk, which are inherent to fixed rate credit allocations. Next, I would say diversification. Owning a risk diversified portfolio, again, of asset-backed senior secured financing, we think may certainly be prudent at this point, given the heightened potential risk of default in unsecured investment grade and or high yield credit. And then the last, as Orestes has outlined, the greening aspect. We look at environmental, social, and governance aspects, or ESG as the term goes, which are embedded in the selection and the rating criteria of potential borrowers. So all assets must be compliant with existing rules and regs. And I think it's important in today's environment that you understand that and see how that's incorporated. Orestes, maybe just a bit about our team. As I mentioned throughout the presentation, I'm not sure that there's another group globally who's got collectively the experience and hands-on track record that we do. As I said, in many ways, we've been at the forefront of developing the senior secured high yield floating rate market for maritime finance in the last 10 years. HHX-ESLA Advisory, so you have some sense. We're a private global investment advisory platform. We've got active operations across 5 countries, all in the most relevant hubs for shipping globally. We are acknowledged experts in alternative maritime finance. We've accrued we're an established group. We have a well-respected 8-year track record in managing over $1 billion US in private debt transactions in the global shipping markets. Our clients here in the United States are by and large household names in the institutional investor community, and our legacy funds have produced annualized returns over that period of low teens on an unlevered basis since 2015. So we're experienced, we're in the markets of consequence, we've demonstrated leadership and execution in the space. And having done this for over a decade, we've seen a lot, financing, vessel acquisition, refinance, related ventures through our integrated team and process. As we mentioned, we're also very focused on environmentally sustainable or green solutions through our direct senior secured financings and the services for vessel acquisition and project finance, as Orestes mentioned. We tend to focus on the middle market, middle to upper middle market, private segment of the global industry, although not exclusively, but that's typically where the greatest need for capital is. Just a few words about what a portfolio or exposure may look and feel like as you think about the potential to make an investment with our team through one of our vehicles. Again, this is a portfolio of 100% senior secured, mainly floating rate investments. Our average margin typically is about LIBOR plus 850. Very reasonable advance rates, loan to value of approximately 55 to 75%. And as mentioned, we're focused on constructing a diversified portfolio of maritime assets by segment, by counterparty, and by transaction type. We have the ability to generate additional fees. We typically have short average duration. Both of those can be accretive to portfolio returns when managed properly. We mentioned the compliance aspect with ESG. All finance assets must be compliant with existing industry rules and regulations to reduce CO2 emissions. Importantly, for those of you thinking about how to make an ESG investment which gives you an attractive return, the measurement of that impact is an important one, which is embedded in our process. The dividend on the Blue Nautilus Capital product on a net basis is 6.5% to 7%. That is scheduled for a semi-annual distribution. We do have a robust and actionable transaction pipeline. So to deploy several $100 million into diversified projects immediately is not an issue. And as I mentioned, all projects will comply with current and future international regulations on decarbonization and energy efficiency. If you have questions, obviously we can talk a little bit about that from there. Orestes, just on the next couple of slides, if you want to talk a little bit about ESG issues, and I think to leave you with just a couple of case studies as to how we approach these markets and projects to ensure the right project selection and the active management of that project to deliver superior risk-adjusted returns for investors. Orestes, I'll turn it back to you.
Thank you, Steve. I think that you have covered most of the points. I would like to highlight the following about the ESG. First of all, that our approach is in full compliance with the taxonomy of the European Union and the regulation. So it is we follow the strictest rules currently in place for the ESG criteria, and we start, of course, with our project selection. So all the projects that we consider, they have definitely a green aspect that is considered also in our risk and credit approach. So we have very specific criteria about measuring all of this. And as Stephen said, these criteria are fully harmonized with the strictest regulations in place for greening. This, let's say, greening is reflected also in our reporting in terms of CO2 savings, either per year or per month or per ton mile. That is, let's say, an issue that can be easily, translated to the right measurement. However, I would like to point out that ships that consume more or less, let's say, currently 30 to 40 tons of fuel per day, and they emit 90 to 120 tons of CO2. This is, let's say, the official, let's say, translation. They offer a huge potential to the investors to report, let's say, CO2 savings in their ESG reporting. And you know, all of you, that ESG reporting is mandatory and becomes really an issue for most investors and for investors in this field. I don't want to go into, let's say, huge detail in the business case. However, I would like to show a let's say, a typical case. And we do have all the financial planning tools and all the stress test tools that are required for, let's say, typical risk financing and risk management in shipping. Assume a typical case where the client has two chemical tankers that they estimate, I mean, they have an estimation of earnings of around $10,000 per day for the first 3 years, and then 9,500 for the year 4 and 5. And there is, let's say, an OPEX operating expense of around 5,800. So given this, let's say, basic input, we can finance the ships with a loan that is close to 62% of the total value. And we can definitely agree the terms with the owners, and this results into an annual net profit for the owners, and of course a very, very comfort debt servicing for us. This could be, let's say, a typical case where these ships normally would not be served by the banks because they are, let's say, more than 10 years old, or because the banks do not have the capacity of financing them. However, this is a typical case for alternative financing sources. Some of you might say, okay, this is, let's say, the rosy picture. What would happen if, let's say, things change? So assume that, let's say, the earnings here, they are reduced by 10%. Then how would, let's say, the total picture look like? And as you see, of course, the cumulative net profit for the owners might be less at the end of the day because we have less earnings. However, the debt servicing is always, let's say, in very comfort levels. And this is, let's say, quite normal to run stress tests, not only for, let's say, reduced earnings, but also for increased operating expenses, for, let's say, less operating days, employment days per year, and of course, all parameters like increase of LIBOR or other base interest, etc. So this is, let's say, what we do know very well, and we do feel very comfortable. But keep in mind that in this typical case, what we can also add here is one more, let's say, a column where the CO2 savings are reported, either savings because the cargo has been shifted from the land to the sea, or because the owners have installed greening technologies and they have saved, for example, CO2. And this CO2 saved, this amount is, let's say, always reported, let's say, at the end of the month or the end of the quarter. And this is an input. This is, let's say, a very important element that investors can get and use in their own reporting. So, Stephen, I think that there's nothing else to say at this point. Of course, if there are Q&As, we would be more than happy to answer. Please conclude with our values and services, and I think that we can go proceed to. Yep.
Yeah, certainly. No, look, Orestes, thank you. I mean, we've got about 35 minutes today, and we do want to reserve some time for questions. I mean, I would simply leave you with, Orestes, if you just forward to the next slide to conclude the comments. Not only do we appreciate the time and opportunity to present the information today and the opportunity, but I would tell you that, you know, making a decision to work with us with and through one of our fund vehicles, you know, we put forth all of the innovations and independence and sustainable solutions. We are everything that you see here on this page. I would simply suggest to you that we have the integrated expertise and the results in this area. There are many who are aspirational in alternative maritime finance. I can tell you that we have been operational and highly successful for over a decade. We're very proud of that, and we're happy to share time with you today. And happy, obviously, to dive in deeper if there are specific questions on the market, opportunities to invest, or the fund structure. But on behalf of Orestes and Ernesto, we do thank you. Ernesto, perhaps we'll turn it back to you if, in fact, there may be questions or further discussion.
Yes, Steve and Orestes, thank you very much for the presentation. Now, I want to ask the participants, are there any questions or are there any suggestions you have for our business partners? Is there anything you'd like to know or discuss further? Can I have some feedback from your side?
Hi, everyone. It's Daniel speaking. One question from Daniel from Aquila Capital. One question from my side is you talked a lot about the environmental aspect of ESG. What about the governance aspect of the investments you're doing or you plan to do?
Hi, Daniel. It's Orestes.
Hi, Orestes.
Hi. I mean, can you elaborate the question about the governance? I mean, because the shipping companies are, let's say, they are not always subject to very, let's say, complicated governance rules. Can you elaborate a little bit?
No, well, my question is more in the direction. You said that it's ESG-driven investment and you comply with your EU taxonomy, but ESG, so there's the environmental aspect, the E, and then there's this sustainability and the governance aspect of it.
Yeah.
And coming from the green investment industry, I know that the governance aspect of the investments is quite important for the investors.
Absolutely. These kind of governance elements and aspects, they are examined when we have, let's say, the discussion with the let's say with the client. In our pipeline, and this is important, we do have a pipeline that is ready to be served. We are talking about generally small and medium enterprise shipping companies that are well established with, let's say, 5 to 15 ships in the market, and they are usually family owned and family run. So the governance issues are examined at this, let's say, point, especially from the credit committee with very specific criteria. So we think that we cover the ESG aspects, not only the environmental, but also the rest of the taxonomy by, you know, by examining and especially, you know, who is behind the company and how the company is run and governed.
Thank you.
Thanks, Daniel.
So I'm looking into the round. Are there any further questions from your side? Please go ahead. All right, I don't see any further questions. So I would suggest that we then close the webinar. I would like to thank our presenters, Orestes Schinas and Steve Pafico from HHX-ESLA team. Also, in the name of XOLARIS Group, thank you very much for attending. If you have further questions that you haven't voiced now, you can always contact us by email. You can contact either the presenters or myself, and we will gladly share or forward you some more information. So what I will do is I will end this meeting, and thank you very much, and I wish you a good day. Thank you.
Thank you.
Thank you.